U.S. natural gas prices extended losses after the latest EIA report confirmed another larger-than-expected storage build, signaling that inventories remain comfortably above seasonal averages. The 80 billion cubic feet injection lifted total stocks to 3,641 billion cubic feet, now 157 billion cubic feet higher than the 5-year mean and 23 billion cubic feet above last year's level. With output still near record highs around 107 billion cubic feet per day and gas-directed rig activity holding steady at 118 rigs, the market remains well supplied heading into mid-October. Weather models added further pressure as forecasts show only brief, localized cooling in the west and northwest, while the broader U.S. outlook points to mild demand. LNG flows at roughly 15.8 billion cubic feet per day and steady electricity demand growth have offered limited relief, failing to offset the weight of ample domestic supply. As a result, sentiment has shifted clearly bearish, with traders expecting storage levels to approach or even exceed 3.9 TCF before the winter heating season begins. The recent uptick in the U.S. natural gas rig count to around 120 rigs, the highest level since August, suggests producers are gradually ramping up drilling activity amid stable to strong output levels already near 107 billion cubic feet per day. Although the weekly increase seems modest, it's a signal of sustained upstream confidence. Producers appear to be positioning for steady or higher production through the winter season and into early 2026. This trend, if it continues, will amplify supply resilience. Even minor gains in active rigs often translate into higher output with a lag of 2 to 3 months, especially when efficiency and well productivity are already high in major shale regions like the Haynesville, Marcellus, and Permian. If production remains elevated while demand growth underperforms, due to mild weather or stagnant LNG export growth, the result will likely be a renewed storage surplus, putting downward pressure on prices through late 2025 and possibly into early 2026. In the short term, over the next month or two, gas prices are likely to stay under pressure. Any short-lived rallies will probably be met with selling unless weather forecasts suddenly turn much colder. Looking a bit further out, into the next 3 to 5 months, the recent increase in rig activity could start showing up as higher production by December or January. That means more gas available during the winter, which could make it harder for prices to rise even when demand peaks. And in the longer run, beyond early 2026, if drilling stays strong and production keeps expanding, the market could remain oversupplied. Prices would only get meaningful support if LNG exports grow faster or new pipelines help move gas more efficiently to where it's needed. In summary, the recent rise in U.S. natural gas rigs strengthens the supply side and adds bearish weight to prices for the coming months. Unless colder than normal weather or LNG demand provides a strong counterbalance, the increasing rig activity will likely prevent a sustained price recovery and could push prices back toward the $3.20 to $2.90 range by late autumn. Nevertheless, it's worth noting that any unexpected geopolitical event or a colder-than-expected winter could temporarily lift prices above $3.50 for a month or two. However, given the strong production backdrop, the market is likely to drift back toward the $3 range sooner rather than later. From a chart perspective, the November contract's decisive break below the $3.20 support has shifted momentum to the downside. The next major support lies around $3.06, which marks the late September low. A close beneath this threshold could expose deeper downside targets between $3 and $2.95, where a potential short-term base might form. The bearish bias will likely persist as long as prices remain below the $3.30 threshold and sellers continue defending the $3.30 to $3.40 resistance area. Momentum indicators also signal weakening buying strength, confirming that the path of least resistance remains lower unless weather or LNG demand surprise to the upside. In summary, fundamentals continue to lean heavily bearish, supported by strong output and high storage, while technically, a sustained move below $3.06 would reinforce the downside trend toward the sub-$3 zone, assuming no sudden speculative news or colder weather forecast shifts intervene. Please don't forget to comment, watch the previous video, and show some love for the channel. See you next time.